Building a dividend portfolio can be a lot like planning dinner. Do you like to carefully craft a dish, picking each ingredient yourself? Or maybe you prefer a meal kit, saving you time and stress. Before you enjoy your dividend delicacy, it's important to know the difference between dividend stocks and dividend funds. So let's dive into the pros and cons of each. First up, dividend stocks. Individual stocks may give you greater control over your investments. Voting rights are one example. Shareholders typically get voting rights that let them have a say in the direction of the company. The costs tend to be lower as well, with trading commissions generally the only ones in the mix. Lower fees mean more opportunity for your investment to grow. That said, holding a relative handful of dividend stocks alone could mean your portfolio lacks diversification across different sectors and geographies, and that could put your portfolio at increased risk. If a dividend stock you hold stumbles, your portfolio value might also take a bigger hit than a more diversified portfolio would. Investing in dividend stocks can be a great fit for investors who enjoy digging into research reports and following business news. But for those who don't want to make this effort, it could feel overwhelming. And skipping this background work could come with consequences. So for a more laid-back, hands-free approach, a dividend ETF or mutual fund could be a good fit. The fund manager does the heavy lifting of picking which investments to choose, saving you the time and stress. And because funds can be made up of dozens, if not hundreds of investments, you get to spread out your risk rather than putting all your eggs in one basket. That can be a huge win for beginner investors wanting a set it and forget it strategy. This route does have some trade-offs, however. The fund manager gets paid a percentage of the fund's total value each year, called the management expense ratio, or MER for short. For example, if a fund's MER is 1% and the fund has $10,000 invested, that means the fund manager would get paid $100 per year from the fund, which can chip away at the returns of the fund. A higher amount of diversification may also lead to a lower overall yield than an individual stock can provide on average. Let's bring back Olivia. She's been reviewing her options, but just can't seem to decide which approach is best for her. But does she even have to choose? Olivia may not have a whole lot of confidence in picking individual stocks just yet, but still has some specific companies she wants to invest in. She could make a portion of her portfolio invested in individual stocks she likes and another portion invested in dividend funds. This can give her the best of both worlds, some reduced risk by investing in more diversified funds, and a bit of extra growth potential from her individual stocks. If she develops a higher risk tolerance, becomes more confident in her investing knowledge, or has more time to do research, she could always reallocate her portfolio to take on more individual stocks if she's up for it. Bottom line, each approach is unique and can be customized to meet your individual goals and risk tolerance. Dividend stocks can be a great approach for a research-oriented investor who's maybe more active than a set-it-and-forget-it investor. And dividend funds can be great for those who want reduced risk or who have less time or willingness to sink their teeth into research. There is no right or wrong answer. What's important is that your portfolio works for you rather than the other way around. So what are you leaning towards? Stocks, funds, a little bit of both? Be sure to join our next lesson where we'll explore how to choose stocks and funds to build your portfolio.
Have more questions? Check out the links to the right and in the description below.